Good afternoon, everyone. My name is Bob Stone. I am the former past chairman of University of Michigan Hillel, as well as a partner at Telemus Capital in Southfield, Michigan. Telemus Capital is a registered investment advisor, an independent registered investment advisor with offices in Southfield, Michigan, Ann Arbor, in Chicago. I'd like to welcome you all today to a webinar we're putting on for University of Michigan Hillel, as well as various Hillels throughout the United States on year-end tax planning. Our panelist and our presenter today is Andy Bass. Andy Bass, in his former life, was a tax partner at a large nationally recognized accounting firm and has joined us back when we started the firm in 2005. And Andy's position here is our Chief Wealth Officer. Andy works with all of our clients with tax and estate planning issues and advises them on all matters in estate planning and tax planning. The webinar should take about a half an hour. If you notice, there is a question box on your screen. If you have any questions, please type in the questions and we'll try to get to them at the end. Also, we will be posting this webinar. We're taping it, so the webinar will be posted on our website, telemus.com, within the next 2 or 3 days. And if you have any questions post this meeting, and I'll announce this again at the end, but if you have questions post this webinar, you can always send me an email at rstone@telemus, and that's TELEMUS.com, rstone@telemus.com. And with no further ado, I'd like to present Andy Bass, and he will go through the webinar with you.
Great. Thanks, Bob. First of all, I want to thank everybody for participating today, as it shows your interest and commitment to philanthropy. As I think you may or may not know, over 30% of all charitable giving happens in the month of December, with 10% actually happening in the last 3 days of the year. So our presentation today is very timely. I just want to make a shout out to Hillel for a couple of reasons. One being both a past student and a parent. Organizations such as Hillel provide students and their parents, such as me, a great sense of security and a home away from home, and they definitely need your support. So I hope that you'll use this presentation and figure out a way to tax efficiently make a donation to Hillel or what other charity of your choice. Our goal today is to provide a very high-level overview of the current individual tax structure with an emphasis on how to maximize the tax benefits associated with charitable giving. I suggest, if you're only listening in, that you request a copy of the slides that we do have for the presentation. You can maybe email Bob with the email address he gave you, and he can send you the slide deck, as we do have some examples to try to quantify for you the benefits of different forms of charitable giving. And I guarantee you it will be hard to follow along that section if you don't have the slides in front of you. Tax planning has always been very strategic, but with all of the tax law changes recently, it has become much more focused on income, timing, characterization, taking advantage of advantaged income sources. But given that we're less than 30 days left in this year, really what we have now to talk about is deductions. And that's what we're going to be focusing on, how charitable deductions can figure into your year-end planning strategies. So with that, let's see. Okay, great. So one of the big issues we've had, especially a lot of charities have faced, is the change in the tax law has really made it much less tax advantageous to make donations unless your income and deductions are such that you're actually getting a tax benefit for those deductions, which is really why we're here talking today on how you can do that. The standard deduction for an individual filing as an individual is $12,200, and double that to $24,400 for a married couple filing jointly. What that basically means, and those are really a significant increase over what they were in the past, is that until your total deductions exceed those two thresholds, you're not getting any immediate or incremental tax benefit for a deduction. So our goal is, how do we get an incremental tax benefit for a charitable donation given these high thresholds of standard deductions? Making it even harder to achieve that goal is the fact that the tax legislation has limited the deductibility of one of the largest deductions, state and local taxes, commonly referred to as SALT deductions, to $10,000. And not only have they limited it to $10,000, they've made that $10,000 limitation the same if you are single or filing jointly. As a result of that, if you look at just the factors, if you're in a high tax state and you have $10,000 or more of state and local deductions, for a single person, you've met roughly 82% of the goal of getting itemized deductions more than the standard deduction. But if you're a married couple with the same $10,000 limit, the limit is only roughly 41% of the standard deduction. So you have a lot more deductions to fill in the gap before you're incrementally over the standard deduction. Combine that with the impact of the recent legislation that actually suspended or no longer allows until the law is changed or reverts back to what it will revert to in 2026, are a lot of what was previously referred to as miscellaneous itemized deductions, unreimbursed job expenses, investment expenses, tax preparation fees, etc., which were all itemized deductions, are no longer deductible on the individual return. So where does that leave us? We still have some allowable deductions. Home mortgage interest, but keep in mind there is a limit on the overall amount of the mortgage that's deductible. Healthcare costs are still deductible, but you have to meet a threshold of 10% of adjusted gross income. Investment interest expenses, but they're limited as well. Gambling losses, and finally, charitable deductions. So charitable deductions really are a key in trying to maximize your tax situation in any given year, because it's one of the truly last discretionary deductions allowable under the law. Basically, tax benefits of the tax benefit of the charitable deduction will be realized as long as the charitable deduction and all of your other itemized deductions exceed the standard deduction that I referred to previously in the last slide, $12,002 or $24,400. So the goal is to figure out how you can get your deductions in a given year to exceed your standard deduction and therefore get an incremental tax benefit. Charitable deductions include cash or property given to any 501c3 charity. Now, keep in mind, there's more than one kind of 501c3 charity. They're both public and private charities. Public are what you normally think about: Hillel, a university, American Cancer, whatever. A private foundation, however, has other limits, and it's typically, you typically aren't, typically most private foundations are being funded by an individual family as opposed to the general public, but you can have general public contributions to a private foundation, and that's why you have limitations. So if you look at the overall limitation, one of the things the recent tax law did was actually increase how much you can deduct in any given tax year for charitable deductions. Now, believe me, every charity on the phone would love to have this problem, and that is you can donate up to 60% of your AGI in cash and get a current year tax deduction. But keep in mind that 60%, which is an increase from what it was previously at 50%, is limited to cash donations. Property donations or combined property and cash donations will be subject more likely to a 50% limitation, and the 20 and 30% limitations are typically there for private foundations or property only contributions. So make sure you understand who you're giving to, what kind of charity, and what you're giving to, making sure whether it's cash or property, and whether the property qualifies for a current deduction or not. But don't fear, if you end up giving away too much, Any excess contributions that you've given are allowed to be carried forward for up to 5 years and deducted in the future years. So it's not lost if you give away too much in any given year. Donation values are generally equal to the fair market value of the property, but can be limited to cost basis in certain situations. So be very careful. We'll see that when we come to donations of property, typically securities and other kinds of assets that may be short-term rather than long-term property. So again, trying to highlight what are some current ways to make donations. Obviously, cash is the simplest. You can contribute cash, get up to a 60% donation deduction, and not worry about a limitation unless you're going over your AGI level. On the other hand, appreciated property has their own set of rules. If you donate highly appreciated stock, as an example here, make sure you own it more than a year. Long-term capital gain property, you get a deduction for the fair market value. And with the deduction for fair market value, that means basically you escape the long-term capital gain tax as well as the net investment tax that may be imposed on had you sold those properties rather than donated them. But be very careful, as I said previously, make sure these are assets you've held longer than a year. Short-term capital gain property, you'd be limited to a deduction equal to the cost basis of the property rather than the fair market value. Another interesting strategy, which is relatively recent, was what's called a qualified charitable distribution. This is a distribution from an IRA directly to a charity, but in order to qualify for this deduction, you must be 70 and a half or older on the date of the distribution. Doing this basically doesn't get you a deduction because you're using pre-tax dollars, but you're not picking up the distribution as income. So if you were subject to RMDs because you're now over 70 and a half, you don't have to pick up your RMD to the extent of the maximum qualified charitable deduction, which is $100,000. So you're not picking up the income and at the same time not getting a deduction on your individual tax return for the payment to the charity. A lot of people say, well, why do I want to do this? There are a lot of reasons why you want to do this, and we'll go into it a little later. But first of all, avoiding taking the distribution and then making a actual distribution of the equal amount to charity, you avoid state income taxes, and then you avoid potentially a lot of what I call stealth income taxes. What's a stealth income tax? If you pick up your RMD, you're now increasing, for example, your Medicare taxable income that will impact your premiums that you may be paying for Medicare. So that there are multiple reasons to consider using a qualified charitable deduction if you're over 70 and a half. And we'll go through some examples to try to show that. One of the biggest activities and interests we've seen recently are basically contribution to donor advised funds. A donor advised fund is a way for an individual to contribute money to a 501c3 charity with the understanding that the 501c charity is taking this into their fund and will then consider direction from you on what to do with the funds in this donor advised fund in the future. So in other words, it becomes a charitable pocketbook. You're donating money in 1 year and then using it in future years to fund charitable needs. And why is this important? As we demonstrated earlier, you're not getting an immediate benefit for any charitable deductions to the extent that they have not exceeded the standard deduction. And this is a way to bunch deductions into 1 year, get the greatest tax advantage possible, and then use this donor advised fund as a charitable pocketbook going forward to fund all of your future donations. You can fund a donor advised fund with cash. You can fund it with long-term capital gain property. By funding it early, you've removed the assets from your estate. And if you want, when future donations are made out of the donor advised fund, you can either be anonymous or be designated as the one making the donation from your donor advised fund. So basically, it's a way for you to maximize your current deduction while funding future charitable needs. Okay, now we wanted to get into a little bit more of the mechanics. In other words, how do these tools really help? And one thing I want to point out, if you're really considering a substantial gift to any kind of a charity, the first thing I would suggest is talk to your tax professional, and more importantly, talk to the charity that you're thinking about making a gift to work with their donor office, because there are a lot of what I would call many sophisticated ways to use these basic principles in a way that may fit your needs best. Some examples might be charitable remainder trusts of various sorts that could help you achieve goals, long-term income needs, as well as avoiding taxes. And so any substantial gift, work with the charitable office associated with the charity that you're planning on giving to work with them and your tax advisor to come up with the most creative way to reach your goals. And that's what I tell them that's what we try to do with all of our clients, work as a team approach. So given that, let's kind of take a quick look at how really one of the one thing you should all be considering if you have both cash and appreciated assets, why appreciated assets can actually be more beneficial to make your donation than using your cash, which is an after-tax asset. So in the example that we wanted to share with you, let's assume you have a stock worth $10,000 and a basis of $1,000. Assume you're married in 2019, your income tax rate is 24% and your capital gains rate is 15%. And you also hold $10,000 in cash. So you have three choices. One, you could donate cash. Option two, you could sell the stock and donate to the charity the after-tax proceeds, or you can just donate the stock to the charity. And what are the advantages of each? Obviously, if you gave away your cash, you're going to get a $2,400 benefit from a $10,000 contribution because you're in a 24% marginal tax bracket. The charity is going to get $10,000. Very easy to understand. On the other hand, if you was to sell the stock and then donate the after-tax proceeds, you're essentially going to be making a donation of $86.50, which is the $10,000 less the taxes due of $13.50. And so if you look at what the charity is getting, they're only getting $86.50 in this by selling the stock, and you're only getting a net tax benefit of $726 because you've had to pay tax on the capital gain, even though you get a tax benefit from the contribution of $2,076. Finally, the third option, which is really the best option, is donate the stock outright. You now donate a $10,000 stock that you've held more than a year. You've avoided a long-term capital gain of $13.50. You've gotten a tax deduction for the full value of the stock, $10,000. And the charity's gotten the stock for $10,000 that they could immediately sell and get $10,000. So the net benefit of using stock rather than selling the stock or using cash is that you're ahead from the tax benefits, and the charity's in exactly the same place as they would have been had you donated cash. So using appreciated assets with this very simplistic example is a very powerful tool to consider at year end for making your donations. The next one that's a little harder to understand is the qualified charitable deduction. This is deduction only available for taxpayers over age 70 and a half. And by being over 70 and a half, you would have been subject to RMD, or required minimum distributions, from your IRA anyway. So in this example, we're basically pointing out that let's assume you have a required $165,000 IRA distribution, of which $10,000 is donated to charity. And let's make it very simple. You have no other income, you're married, and you have potential itemized deductions of $20,000, $10,000 of whatever, in this case, medical expenses over the AGI limit, and $10,000 of charitable deductions. So let's look at why a qualified charitable deduction is beneficial. Option one here, no qualified charitable deduction. Distribute $165,000 to your bank account and write a $10,000 check as a donation. You're picking up $165,000 distribution from your IRA. You're going to get the standard deduction. You're going to pay your taxable income of $140,000, and you're going to pay tax of $22,649. Let's look at option two. You're going to only have to pick up $155,000 in income because you used $10,000 of your distribution to fund your charitable deduction. So your income is less. As a result, your standard deduction is exactly the same, but your taxable income is $10,000 less, and you've paid only $20,449 in income taxes. So you're in the exact same position, but you're now ahead $2,200 of your tax savings by using your qualified charitable deduction. Again, only available for individuals over 70 and a half. Finally, we wanted to kind of explain this whole donor advised fund and bunching. Bunching is really the tool for the future until something changes, and if your would otherwise be less than the standard deductions, because it's a way to combine multiple years worth of itemized deductions into 1 year in order to get a deduction. So let's take a look at this scenario. Let's assume you have AGI of $300,000 and it's all ordinary income. You're married, you itemize deductions, you plan to donate $20,000 a year for the next 4 years, and you can fund this donation either with cash of $80,000 or long-term capital gain type stock worth $80,000, which you have a basis of $2,000 in. And then so our options are make the deduction, cash deduction up to 50% of AGI, or appreciated stocks deduct up to 30% of AGI. So let's look at the scenario of what you're doing here. So this is a multi-year example. Let's assume you just do cash gifts every year. From this year through 2022, your AGI is 300,000. Your state and local taxes are 10. Your charitable deductions are 20 in each year. Your itemized deductions, therefore, are $30,000, and your taxable income is 270, and your annual tax liability would be 53,149. So your 4-year tax liability would just be 4 times that, or 212,596. Let's assume instead you front load by making cash, by bunching into this year all of your donations, 20,000 for the next 4 years, into a donor advised fund. You now, instead of having 30,000 of itemized deductions, you have 90,000 of itemized deductions, reduces your taxable income, reduces your resulting tax liability, and the result is, when you look at this year and then the next 3 years, you basically have reduced your overall tax liability down to 201,000, and resulting in a overall income tax savings of $10,912. On top of that, if you look at using appreciated stock to do this, you would save another $11,700 in savings that you would have otherwise had to pay on the capital gains of the stock, resulting in a total benefit of bunching into $22,612 by bunching your 4 years worth of charitable deductions into 1 year rather than spreading them out over the next 4 years. So that's really the basics of what we wanted to describe to you, and that is there are much more tax efficient ways to be able to donate, make your donations other than cash, and by considering the timing of your donations and bunching them together. And finally, like I said earlier, there are hybrids of all of these that you should consider, especially using appreciated stock when making a large contribution, because you can donate money or stock in this case to various kinds of structures where either you or the charity get an income stream and your family gets the benefit of the income stream or the residual value, depending upon how you set up a charitable remainder trust. There's a lot, they're very powerful tools that you should all be considering, and I hope that you consider these creative ways of giving as you approach your year-end giving this year. So with that, if there are any questions, I'd be happy to take any questions, or if anybody needs a copy of the slides, you can get them off of our website or contact Bob directly.
I am looking, we'll hold on for a couple more minutes, but in the lower right-hand corner of your panels, there should be a question box. I see a couple questions about being able to see us. We were supposed to be showing the slideshow. If for some reason the slideshow wasn't showing, I apologize. Andy and I are old men and we don't understand technology too well, so we can easily send it out to you. If you have any questions and or need copies of the slide, once again, my email address is rstone@telemus.com, and we will also post this, like I said, on our website at telemus.com within the next couple days. I don't see any questions popping up, so with that, I will say thank you very much for attending, and we look forward to doing this again next year. And once again, we missed Giving Tuesday, but you still have a couple more days till the end of the year to make your charitable donations to the charity of your choice, and hopefully one of those charities of your choice is the Hillel that you're affiliated with in one way, shape, or another. And with that, I will say goodbye and thank you very much for attending.